G'day expats, welcome to another episode of Expat Chat, episode 65 today. And as always, joined with my friend, work colleague, business partner and mentor, co-host, Brett Evans. How you going, Brett?
Mate, with a introduction like that, I can't even walk in the room without turning sideways. So thank you very much. And folks, joined by my mate in-house, Mr. Ridley. He's
I
in
am.
Dubai. James is the managing director for the APAC region, looks after clients in Asia and the Americas, and is in the hood as we speak right now.
That's right. And I guess I didn't obviously throw in your title there, Brett. I'm in managing director for the EMEA region, and you're right. I am in Dubai right now. I'm still shaking off the jet lag, which I think I can see right now. Just under my eyes, even though I've been here for a few days. Um, it's good to be here. It's obviously, yep, it's a bit of a sandpit. The last time I was here, back in 2020, it's amazing to see how much infrastructure development has happened. It's ridiculous. You just can't slow down this city. And I have no doubt when I'm back here again, it'll blow me away again. Probably cars might be flying around, to be honest, the way the way this place moves.
Yeah.
So it's good to be here. It's not as hot as I thought it'd be, so that's actually a refreshing change. But listen, digressing a little bit, I want to talk about a very important topic today, which I think is on the lips of most expats, depending on the country they're in, is currency. The currency movements of late have just been very
Bonkers.
erratic. Bonkers, they have. They've been wild, and I mean the major trade currency US dollar against the AUD. I think when I reflect back 4 months ago, I didn't think it'd actually get this low again. To be honest,
No.
don't know if it's got much more left in it, but it's very interesting to see what's going on when we look at all the different currencies around the world.
Definitely, mate. And let's get the jingle out of the way and disclaimer to keep all the compliance peeps happy out there. All the
That's right.
information that the folks are going to have the pleasure of listening to and watching today should be construed as informational and educational purposes only. Please do not construe this as personal financial advice. If you do need to seek advice, chat to us, Atlas.
That's right. Now let's jump into it. So now I think if we look at even just the AUD versus the US dollar, even in a space of 2 or 3 weeks, it's dropped about 2 cents. So on our
Yeah.
side, the Australian side, when I look at the currency, it's it was 60, I think it was 63 cents, 63.9 yesterday. Now it's back up 64.2. But 2 weeks ago, it was trading about 65, 66. So it's dropped pretty aggressively. And I mean, I think there's a few things feeding into that. I think there's a bit of hysteria, a bit of a risk-off approach happening. But it's interesting when we compare that to other currencies around the world as well.
Look, it is. I mean, everything's relative and the grass is always green on the other side. So for those folks out there who are earning euros or pounds, they're probably looking at those folks earning US dollars with a bit of jealousy.
Yep.
But in the same token, those folks who are earning USD or USD pegged currencies, the Riyal, the Dirhams, the Dinar, Hong Kong dollars, all those sort of
That's right.
things. Yeah, they're sort of smiling right now. So as I said, it's always a glass half full approach depending on which side you are, whether it's
Yeah.
glass half full, glass half empty, depending on what currency you're earning. But certainly the conversation is monopolizing clients' conversations right now.
Mm.
Do we move funds? Do we
Yeah.
hold off? Do we zig? Do we zag? And I think that's what we want to run through on today's call, because to me, people can overthink things. And,
They can. Yep.
I remember like it was yesterday, March 2020, when COVID first hit, the dollar fell to 56, and I was having a lot of conversations with clients about, do we move money back? And my answer was yes. And they said, oh, might have a bit more further to fall. And I said, well, look, if you haven't actually done a trade, you haven't actually locked in a price, it might as well be 75 cents, because it's only when you actually do that transaction that you lock in that price and you've received that benefit of that price. And right now we're having that same conversation with clients. They're like, oh, it's got to go to 60. It might do. But if I said to you 12 months ago that you could get within 2 or 3 cents of the bottom and you'll be transferring money with a 6 in front of it and potentially below 65 cents, would you have done it? The answer is unequivocally yes.
That's right.
But now people need to take the emotion out of it in terms of them trying to guess where the currency is going, and to say, if you like the price, take it.
Oh, I like the price. It's a pretty attractive price, let's be honest. And I mean, I really don't know if it has much more to go. I feel like most markets are at fever pitch at the moment with just being nervous around obviously economic data, and that's why there's a risk-off approach with the AUD. And And that's why US dollars is so strong at the moment. I mean, there's a little bit obviously feeding into it. Commodity prices have come off a little bit. But when you compare our currency versus, say, the Chinese yuan,
Yep.
or I suppose the RMB, very similar movements since the start of the year when you look at
Track
both our
sideways.
currencies. Yeah,
Yeah,
yep,
it's
that's
actually
right.
tracked sideways, and the RMB was holding to the US until about April this year, and then
Mm,
that sort of artificial pegging fell
that's right.
apart, and off it goes. But obviously you and Jeremy, our mortgage broker, are here in Dubai right now, and we're down in Abu Dhabi this evening, presenting to
Mm,
clients about all of these things. And one of the interesting slides that we're showing in this, and it's, I always say a picture tells 1,000 words, is the US dollar compared to the Australian dollar, the pound, and the euro.
that's right.
And just feel sorry for the expats who are earning pounds at the moment, because
Yeah.
their purchasing power has gone down. So I think as of Tuesday, when we did the slides, the pound's down about 22% for the last 12
Mm,
months against the
it
US.
is.
The euro's down 17. The Aussie's only down 10. So
Mm,
yes, the Aussie is more appealing, but the reason why the pound's down more against than compared to the pound's down more against versus the Aussie
mm,
is because right now we are now sort of talking about austerity measures coming into the UK, because they are starting to cavitate. Those people out there who are in the boats or planes understand what cavitating is when you stall. If you're a plane, you stop generating lift, and if you're in a boat, you stop generating propulsion.
mm,
And it really comes back to, okay, what's the next step for the UK? Obviously,
yep.
Truss is, Prime Minister Truss is looking at doing a number of tax cuts and being quite aggressive. So
Yeah.
on one hand, they're trying to keep the economic growth going. On the other hand, they're trying to slow down inflation. Um, I think what caused this whole movement into the USD is, as
Mm,
you so eloquently pointed out before, it's risk off. Investors
mm,
are nervous. When Jerome Powell came out with that 75 bip rate increase last week, it sort of caught the market by surprise. It was a bit more aggressive than they thought.
mm.
And in the US, you'll hear in the press these things called dot plots. And if you
Yes.
think of a solid line, which is what's
All
actually
the rage.
happened, and then dot plots are where they forecast it going, and
Yep.
it actually it's a bit higher than the market thought. So
Mm,
people right now are reassessing the timeline of what we're going through. At
yep.
the end of the day, the Australian economy is in a lot better position than the US and the UK. That's why we haven't
Absolutely.
fallen as much against the euro or the pound.
Hmm.
But on the other side as well too, it really comes back to, are we going to be in their situation in 6 months' time? If
Mm,
that's the case, then yes, the dollar could fall more.
mm.
But why I don't think the four horse of the apocalypse are coming around the corner tomorrow, and why I don't think we're going to see those sort of falls, is because the Australian economy, generally speaking, is in pretty good position in terms of,
We are.
yeah, they're
Yep.
holding a lot of cash.
That's right.
We've got full employment,
Hmm.
and in a bizarre sort of way, what the US Fed and the Bank of England are trying to do is cause unemployment,
Yeah. 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 Well,
because
I
they,
mean, naturally drive down demand. So
yeah, exactly.
it's,
So
it's a tough one. Yeah. It is a tough one. And I mean, going back to the currency talk you were saying before, and a very interesting slide was that Swiss franc.
yes,
I thought and it's
six
not something
percent
we
up,
often, that's right,
six
not
percent
something we
up.
really talk about, to be honest.
Yeah, we've got clients in Switzerland who are high-fiving each other right now, because not only
Yeah.
is the US dollar strong, but the Swiss franc's even stronger.
Yeah.
So
Yep.
as I said, the grass is always green on the other side for certain people. If you're
Mm,
earning pounds or euros, you're jealous of people earning Australian dollars and US dollars. If you're earning
mm.
US dollars, you're jealous of those earning Swiss francs.
Yeah.
So it's not a situation where you can just suddenly change your situation and change your earning capacity. But
That's right.
I guess the answer for people on the call today, if you're earning Swiss francs, definitely, but if you're earning US dollars as well, then is the Australian dollar appealing? 100%. If you're
Mm,
earning pound or euros, no, maybe not.
yeah.
We may have to have a totally different conversation with them about maybe moving money back to benefit from the low pound and low euro. There's always that option
Mm,
as well too. And you need to look at everything through that lens of polarity across the top.
mm,
Um,
mm.
and the Australian dollar, there's so many different moving parts to the Australian dollar. You've got obviously
Absolutely.
interest rates, you've got economic indicators, commodity prices. We are a
Mm,
resource country. So when
mm.
you look at the Australian dollar versus, say, the Canadian dollar, it's very similar as well, because they've got a very
Yep.
similar, makeup of their economy as well too. So you can really screw your head 3 ways from Sunday, in trying to work out what you should do. And the best thing you should do is not think about it. Do you like the price? Take it.
I'll say this, Brett. I remember quite a few episodes ago we talked about what would make the Australian dollar drop against the US dollar, and this would have been back probably in May. So when commodity prices were quite strong, that was really good for the Australian economy, and I suppose our trade balance at the same time. And one of the main kickers was, okay, if there's a widening interest rate gap between Australia and the US, that's part one. Part two, if commodity prices come off and drop. Those are the only sort of scenarios which can quickly, obviously, dramatically decrease the weight or the value of the AUD, or I guess weaken our AUD or strengthen the US dollar, whichever way you want to put it. And that's actually happened. There's been a little widening gap of interest rates. Obviously, we're not going as hard and as fast as the Federal Reserve. We don't need to because our economy is a little bit different. But that's obviously fed into what's happening in currency. So those two indicators, or those two macroeconomic impacts, have actually played out in the last sort of 4 months. So that's what we're seeing right now. Obviously, it's going to be interesting to see what happens over the next 6 months. One, I suppose, important data pack that we receive next month is that CPI figure. 26th of October, some good data coming out of the ABS. CPI is one of them. There'll be a few things coming out from that, as well as we'll finally get a bit of a half-yearly fiscal update, or economic update, I should say, from the Labor government. And, it'll be interesting to see what's going to be in that in terms of what their roadmap looks like for the next 6 months, the next 12 months, because you've got to remember that fuel excise is now being cut off at the Bowser, so everyone's paying an additional 20 cents at the Bowser, so everyone's going to be filling that. I think yesterday was the last time you could sort of fill up for that discounted price, so everyone back home will start feeling that. But it'll be very interesting to see what happens, the kind of data that we get over the next 6 weeks, because right now markets just data driven, whatever sort of, and it's funny, it is a news vacuum right now. Share markets, currency markets, they're really leaning on just the little words that the Feds are saying, and it could be a case where markets are misinterpreting. We look at the Australian share market just today; it's gone up by 2%. So even the market's having a very difficult time trying to price where to go. It's interest rates going to keep going up hard and fast, or are they not? It just goes to show you definitely don't want to miss those good days, because we've seen what happens when you miss those good days when you're not in the market.
Now, there's two charts that we've used, both in the seminar we did on Tuesday for Dubai.
Yep.
So those people who attended that, great to see you. It was a great night. I think I got home about midnight. So well attended, and everyone loved hanging around and having a chat about. We got a chance to get our data nerd hats on and talk some good stuff. But there's two charts in there that really succinctly pointed out why you should be doing unemotional investing during times like this. First one was that chart that Vanguard did, and they went back and looked at the performance of the market and looked at the peaks of recession, I guess, or the content of recession in those different timeframes. And if you, rather than going into recession, waiting for it to turn and then coming back out again and then buying, they said actually buy in the recession, which technically we're in for most countries right now.
Well, what you just talked about then, and I don't want to cut you off, then I'll let you keep going. What you just talked about then is what investors often display in these times, where it's referred to recency bias. So they extrapolate past returns and they turn them into performance chases, where they'll unfortunately end up selling low and buying high, right, when it should be the opposite. But you don't know the opposite because no one's got that crystal ball. So it just goes to show dollar cost averaging is key. Diversification is key. Rebalancing when necessary. Stay the course. Stay invested and ride out. But you're right. Recessions are the perfect time to actually jump in the market when people are most nervous.
If your time frame is 3 to 5 years,
laughing,
go for it. And the other chart that we're putting up as well is another one where, once again, by Vanguard, they do some amazing research and we use their ETFs and really like their content because it talks about altruistic investing and how to rise above the noise, which is what we're in right now.
Yeah.
When you look at the second chart we use, it talks about the performance. If you got every single peak and trough right, like absolutely smashed it. You got it down to the minute, not the day, not the week, not the month, the minute of every peak and trough. Or if you just stayed the course in a good 60-40 balanced portfolio, the difference is not a big difference at all. It's funny how over time it was actually quite surprising when we found that chart and went, wow, okay, we're definitely sharing this. And for those folks who went on Tuesday, I think it really hit home with them what's going on. Certainly today in Abu Dhabi, by the time this episode goes out, will be after the event. So those who turned up, good to see you. Those who didn't turn up, you missed a good night. So we'll be doing some more of these now that borders are open and you boys can travel. But
that's right.
It really just comes back to dollar cost averaging, unemotional investing, whether it's investing in shares, whether it's transferring cash.
Currency.
Yeah, to me, if you're sitting on a pool of cash in US dollars or US dollar equivalent right now, and your intention is to return to Australia at some point in time, why wouldn't you put a toe in the water and just put the foot in the door and just lock a price? You don't have to do the whole lot, but just lock a price in. Just get it set. Because by doing that, what's going to happen is now you can then have the flexibility and the luxury of doing another one if it does fall. But if it doesn't, it does go up. At least you got that first price in.
That's right. And a lot of I suppose expats, they do sit on the fence. They obviously they always think they could get better. They could get better, but reality, you don't know where it's going. You don't have that crystal ball. At least get your toe in that way. Even from an emotional perspective, if the currency does go back up, you're not going, oh crap, I should have transferred it. Woulda, shoulda, coulda. I think most expats were in a similar situation when it did drop down to that 56, 58. Obviously, that's when COVID hit, so everyone was a big unknown there about probably jobs and all those sort of things. But right now, with most economies pretty strong and the major issue being inflation, if you've got an intention of returning back to Australia in 2, 3, 5, 10 years' time, currency right now is pretty good. We don't often have the currency this low and it holds this low forever. It's usually in the 70s that we see it consistently. So right now it is very attractive. I think when it dipped down to 63.9 yesterday, I was shocked, to be honest. But since then, it's already jumped back up, 64.3, 64.4. And if we have some more renewed confidence in share markets, I can guarantee you we'll see 65 cents pretty quickly. So
risk on again, risk on quickly.
That's exactly right. Everyone will flood out of the US dollar and start investing in the other markets. So you've really just got to dip your toe in if you want to, one, make yourself feel good that you got in as well. And it can be just that first step, which helps sort of you move into that dollar cost averaging phase as well. You understand the process now.
Got to get runs on the board. Otherwise, paper trading, you don't make money. You actually need to commit. And if you are listening to this or watching this and are on the fence, press pause, jump onto your Waze, OFX or Wise app, start it, do it.
Yeah, that's it. Yeah,
because
we'll wait. Press pause. We'll wait.
We'll wait. We'll sit here. Just we'll play some hold music and stuff. But it's just do it because these things don't last forever. They are a short and sharp dip. If we go back to April, May this year, when the central bank governors were talking doom and gloom around the world, they were trying to talk the economy down. Equity markets fell quite a lot, and then 30 June, companies reported their results. Guess what? The wheels aren't falling off. We're fine. It was them talking it down. So, and this could be the same thing again. It could be Jerome Powell trying to scare the bejesus out of the US economy, saying, guys, a lot of you will be out of a job unless you slow down.
Oh, yeah.
That in turn may cause it. So the dot plot may actually not be as aggressive as what it might be.
That's right. And we won't get much more data from companies' earnings until after December, unfortunately. But tell you what, if it's another strong season, you are going to see that cyclical lift. We always have that seasonal effect happening around January. It's actually just called the January effect when that sort of portfolio rebalancing happens. Traditionally, you always see a bit of a lift after October. Historically, September and October, they're always volatile periods. But
Christmas rally into December. Yeah.
That's right. Yep. After that, that's right. So seasonally, after October, share markets usually have usually a good period. But right now, they're feeding off the economic data and unfortunately what the Feds and the RBAs are saying, whether it's at a conference or obviously the minutes that they put out.
Exactly. And I think for those folks out there who are looking for the crystal ball number, no one really knows. Do we think it's going to have a 5 in front of it? I'll give it a 10% chance. Maybe 20% chance. Is it going to go to 62, 63? In the long scheme of things, is it going to make a difference? Otherwise, if it goes back to 72, 75, that's going to make a huge difference. So
That's right.
don't try and be too clever.
Yeah.
Maximize, take advantage, use and abuse the price is there for the taking.
Mm. Mm.
Don't put all your eggs in one basket unless you've got a short-term time frame of repatriation and you need to move it all. Then in that case,
Yep.
it's good. But
Yeah.
yeah, for those who are staying overseas for longer, yeah, why not?
Absolutely. Absolutely. It's right now, as you said before, currency, it's ebbs and flows. Right now, it's a good time if you're on the US dollar side. In the future, if you're expatriating or repatriating or heading over to currencies which are quite strong, it'll come back around. There'll be periods where, you'll get it then, but that's why it's important to dollar cost average.
And it's a good lesson for those in Europe and the UK as well too, of the importance of diversification, of having money outside of your home country.
Mm,
Because
mm,
yeah, you got a 12% differential between the Australian dollar and the pound.
mm,
So if you were working in the UK, repatriating money back to Australia on a regular, ongoing fashion and investing that money, guess what?
mm,
You've had a 12% uplift in your net wealth just
mm.
in that
That's
money
right.
sitting in an Australian denominated account.
That's right.
So yeah, I mean, you don't have all the eggs in one basket. You should always be globally diversified. But yeah, you never see these things coming. In hindsight, you do.
Mm,
And you shoulda, woulda, coulda. But just at the moment, you need to be practical. You need to keep the path.
mm.
Just because these things are happening around, it doesn't mean the world stops. The world
That's
keeps
right.
turning. The sun keeps rising in the east and sets in the west. And you just need to keep being disciplined in your approach, whether it's investing, whether it's transferring money by doing it. You got to get highs and lows. But
Yeah,
overall, it's going to
absolutely.
average out to be a better price.
That's right. And I mean, to give our listeners a little example, I had a good call with a client recently and they've got some shares invested in the US exchange from their employer. Um, and those shares have dropped technically, I think it was 17% since the start of the year. And I said, okay, well, you know, that's in US dollars, but you're doing a lot of different things back in Australia. So if you actually sold out of those shares, converted the US dollars to AUD, knowing that the US dollar since the start of the year has actually gone up and gained by 13%, well, you're actually only 6% down for the
Down.
year.
Yeah.
That's pretty impressive considering where all markets are. And off the
Yeah.
back of that call, they're like, "Yep, you're right. Actually, I'm gonna lock that in and send that cash back, and then reinvest in a low point in the market." So they're making use of that currency gain as a good little hedge and I guess stopper. It's good.
Yeah. Everything's relative at the end of the day. And I think that's the biggest thing we always talk about with clients is you can always find someone who's better and worse off. But
That's right.
what happens to you is up to you.
That's right. And I mean, if share markets begin to lift aggressively, I can guarantee almost with high level of probability that the current exchange rate won't be there anymore. You'll see
No,
the Australian dollar will weight back up towards 70 cents because renewed confidence will be not just in one market, it'll be in many. So you won't get it on both sides. Absolutely not.
exactly. So, and I think we've delivered the point. I think we've pushed the point through. The Australian
Hmm.
dollar might go a little bit lower from here, but it is bloody low compared to
Yeah.
where we were 12 months ago.
Hmm.
Maximize, make the most of these opportunities. Don't be an analysis paralysis where you just get frozen by indecision.
Yes.
Just commit.
Yep. Pull that trigger. Absolutely.
Okay. So, mate, let's wrap it up there. Housekeeping, guys. I haven't looked in the last couple of days. We're getting close to 4,000 signatures on the tax resident petition. Please,
Yes.
we've got until the 5th of October. Let's drive this. So please
Mm.
sign it yourself. Share it with all the friends and family you've got. Whether they're expat or not, doesn't matter. It
Yes,
is,
that's right.
yeah, when you think about the last time that we did change the tax residency rules back in 1936, we're in 2022. So in all of our lifetimes, there's a very little chance that they'll revisit this again.
That's
So
right.
now's the time to have that chat. Now's the time to make
Absolutely.
that call. And yeah, please support us in this because the more signatures we get, the more gravitas we have in Canberra, the more likely to give us some serious consideration. And yeah, let's let our voices be heard.
Sounds good, mate. Absolutely. Couldn't put it better myself. And thanks for stopping by, everyone. And Brett, I'll see you in the office.
Yeah, all right. See you soon.
See you, man.
Thanks, mate.